If you follow the headlines, the One Big Beautiful Bill Act, or OBBBA, promises that 2026 brings massive, effortless tax cuts for every American household. But the reality is different. The wealth-saving benefits of OBBBA are accessible only through high-level financial coordination and proactive maneuvering. To see those savings, you have to work for them. Look at the distributional analysis from the Budget Lab at Yale. They measured exactly who benefits from these new laws compared to current policies. This chart shows projected tax relief across income groups. For the bottom 50% of earners, the benefit is microscopic, less than $100 for the year. Meanwhile, the top 20% will see tax cuts exceeding $1,000. This disparity exists because low-income earners do not benefit from the new deductions or phase-outs. At the same time, high earners face income-limited traps. To access the money, they have to actively restructure their assets. The central rule of 2026 is this: passively handing a W-2 to a CPA in April guarantees you leave money on the table. Tax savings are now a proactive defense game. Let's focus on our first profile, the high earner and real estate investor. Their primary objective is managing strict income thresholds. The primary trap for this profile is the net investment income tax, or NIIT. The NIIT is a 3.8% surtax applied to passive and rental income. This surtax triggers when a taxpayer's modified adjusted gross income hits $200,000, or $250,000 for married couples filing jointly. To defend against it, investors must strictly coordinate asset sales and Roth conversions to artificially suppress their realized income below those red lines. But there is a new opportunity here: the expanded state and local tax deduction cap, known as SALT, offering relief for property taxes. The mathematical hurdle is high. The SALT cap only works if your itemized expenses beat the newly boosted 2026 standard deductions, which are $16,100 for singles and $32,200 for joint filers. To beat those new adjusted gross income floors and actually use the itemized deductions, you have to employ a strategy known as charitable stacking. This table compares the two methods. By splitting a $50,000 donation across both years, a couple overcomes the income floor and yields up to $16,250 in combined tax savings. For high earners, success in 2026 relies entirely on the precise multi-year timing of when income is recognized and when money is given away. Our second profile is the market optimizer. Their primary concern is aggressively shielding their invested capital gains from heavy federal taxes. Their baseline defense is tax loss harvesting, or TLH. Tax loss harvesting involves purposefully selling assets at a loss before the end of the year to offset your realized capital gains. However, this is a tax deferral, not a tax elimination. By resetting your cost basis lower, you may pay higher taxes in a future year. There is also a strict compliance trap. If you repurchase that same asset within 30 days, you trigger an IRS wash sale penalty, which erases the tax benefit entirely. For startup equity, the ultimate high-complexity shield is qualified small business stock, or QSBS. If structured correctly, QSBS allows an individual to shield up to $10 million in capital gains from federal taxes entirely. The trade-off is severe. QSBS requires locking your capital into a highly illiquid asset for a mandatory 5-year holding period, along with extreme legal structuring requirements. Market optimizers can achieve unprecedented tax preservation, but they trade away their liquidity and must navigate razor-thin IRS compliance rules to get it. Our final profile focuses on small business owners and startup founders focused on cash flow survival. This chart shows the impact of the Qualified Business Income Deduction, or QBI. This benefit allows pass-through businesses to deduct up to 20% of their qualified business income. But the deduction is choked off by complex phase-outs the moment a single filer's income hits $191,950. Staying within the optimal range requires careful salary management. Fortunately, OBBBA revived immediate research and development tax credits. This offers a combined upfront deduction and a credit, slashing effective research costs by 25%. For pre-revenue startups, there is a unique benefit. They can use up to $500,000 of this credit to directly offset their employer payroll taxes. The operational cost for this credit is high. It demands meticulous, audit-ready bookkeeping of engineering wages, of cloud computing, and contract research. For founders, maximum cash flow is achievable, but it requires them to run their bookkeeping with the precision of a forensic accountant. This quadrant chart maps the specific relationship between implementation effort and the final tax savings impact. If you have a straight W-2 income, no business, and no passive investments, you belong in the bottom left quadrant. Your best move is to take the 2026 standard deduction and ignore the hype. But for high earners, strategies like QSBS and charitable stacking offer maximum capital retention. Naturally, they sit at the absolute peak of required effort. If you are brushing up against the $200,000 thresholds or running a business, you can no longer afford to treat taxes as an annual April chore. Capital preservation in 2026 requires continuous, quarterly strategy and professional advisor coordination. Under OBBA, the tax code is no longer just about how much you earn. It is entirely about how, when, and where you classify that wealth. Complexity is the new cost of keeping your money.